Good morning. This is Mike Sicaranza, President of Affinity Wealth Management, coming to you live from his laundry room. This is where my home office is set up. To give you a quick market update, it is actually Thursday morning, and I figured what we would do today, first I hope you're all safe and sound, is give you a market update and talk about what's happened over the last 37 days, kind of update you on what our thinking is relative to our last video. And the reason why I call this market update from terrified to FOMO, or fear of missing out, is that all of us have had the range of emotions from fear to now fear of missing the upside in the market. And so emotions have hit emotional streams on either side of the equation. And part of our job as advisors to kind of filter through the data, give you ideas of what this is, what you should be looking at, what we're thinking about, and then help you make good, sound investment and financial systems based upon your goals and what you want out of your life. So here's our agenda for today. We're going to talk a little bit about what the state of the market is as of this morning. We have a jobless claims coming in about an hour or so. That'll be interesting to see what that number comes over and how the market affects it. We'll talk a little bit about bear market perspective and show you how there's been, in every other major bear market, there's been major rallies off bottoms, but the trend didn't really change. And so the question becomes is, had this most recent rally off the bottom changed the overall trend? And we're going to give you some answers to that, at least in our opinion as of the moment, and what the data suggests. And then we're going to talk about our asset class relative strength scoring and see if there's any changes there. So that's what we're going to talk about today. First, let's talk about the market update. And so, basically in the last 37 days, we've had a major decline in the market, up to like 35 or 36%, I believe. And then within the last 15 days, we've actually had a retracement of about 50% of that major market decline. It's not unprecedented, but it's pretty darn close. What we've noticed to see is that, as of, yesterday, the market was down a little bit, but where the rally kind of at least stopped so far is where there's major resistance ahead. Trends were broken, and now we're hitting up upon those resistance areas. And so until we get through those, it just continues to look like we're in a rally in a bear market. And then, we won't know whether the bottom's in until this is all said and done, but we can certainly use our indicators to kind of help us figure out when the all clear, when trend is changing. Like I said, the indexes, I'm going to show you some data on this, don't look so promising, but there's obviously individual securities that do look promising. Jim Cramer was famously said, there's a bull market someplace. So there are individual stocks that look good. If anyone's been following Amazon, for example, lately, just recently hit all-time highs. One of the key indicators that I look at, and we look at as a firm, is the bullish percentage, and that actually hit an all-time high. And you must be like, yeah, that's great, bullish percentage at all-time high. Well, it's kind of a contrarian indicator. So really, Warren Buffett always said you want to buy when there's, fear. You want to buy when there's blood, blood in the streets and fear, and you want to sell when people are greedy. Well, basically, it hit a unprecedented level going back at least 20 years, which it hit 90 on Monday. So that means sentiment's greedy, which means that we are probably overbought and certainly due for a pullback here of some way, shape, or form. And then the last indicator to signify trend changes and to signify, bottoms potentially in markets has been the 40-week NYSE. And basically what that looks like is it looks at the percentage of stocks that are above their 40-week simple moving average, or 200-day simple moving average, if you want to do the math the other way. Historically, when that number is above 15, or really even closer to 20, that gives you more of an all clear kind of indication that it's safe to get back into equities full scale. Right now we're at 10.93, so we're still below that number. And sometimes I've gotten the question is, well, Mike, we're close. Why don't we anticipate getting above that number, since we have been moving up and use it that way? The only problem with that is that number could certainly reverse back down. and then you kind of get whipsawed. So it's a tool that we use, it's an indicator that we use, it's not the be all end all. We kind of look at, we have our process, we have our rules, but we're all also looking at the weight of the evidence of what's going on. This is a point and figure chart of the S&P 500 in really looking at the ETF, the SPY. And for those of you who have sat in on my columns of O's versus columns of X's and a peek behind the curtain webinar that we're going to put on, we actually did it live for local clients. We're going to do it again via webinar. Just really quickly, X's means that there's short-term strength. O's means that there's a little bit longer-term strength. But what you could see is that that red line was the old S&P trend line, when the S&P was on a positive trend, really going back to about 2016. That trend line got broken. And so once you break trend, what we then do is draw our resistance line, which starts from the peak of the highest column of X's, which is where that 2 is at about $335 a share, and you draw a 45-degree angle down, and that gives you your new resistance line, or your downtrend line. And you can kind of see is that Monday's rally basically took us up to that trend line. And so typically, it's very hard to break through a trend line. It usually takes some time, either time or some sort of backfilling, especially when we've had a move, like I said, off the lows that we've had. So my anticipation is that, although I don't anticipate, my thought process is that until we get above that trend line, the downtrend for the market is still negative. So $285 a share on the SPY is very, very important. We probably need to see a close above that to signal probably potentially the next leg higher in the market. Just to kind of reiterate that point in looking at trends, these are obviously the major indices across the world, and also a lot of the US major indices. And you can see there's only 2 major market indices that are in positive trend. The QQQ, which is the Invesco Trust, and then the S&P 500 Top 50 ETF. And, so we basically have or Top 50, excuse me. So what's that telling us is that since the market has rallied, it's been super narrow, it hasn't been broad, which again, kind of tells us from a data perspective that the way the evidence is still pretty negative, that this is still considered just a bear market rally. And just to give you some historical data wrapped around that, this is the 2000 through 2002 bear market in the S&P 500. And you could see during that time frame, there were significant rallies during an overall downtrend that I think wound up ultimately the S&P being down about 50%. And those are just kind of highlighted in the pinkish orange there. In addition, here's some more examples of some major bear market rallies. One going back to the Great Depression. That first rally off that initial swoosh looks kind of familiar to the one we had now. Market was down significantly after 1929. Then we had a 50% retracement. Sounds familiar. And then the second leg down, and then 60. So ultimately, the Dow Jones was down about 80% when this was all said and done over those 3-year time frames. Looking at the NASDAQ on the other chart, you can see that there was significant rallies, the biggest being 36.3% off the bottom during a downtrend that lasted almost 80% over a 3-year time frame. Now, I'm not saying that we're going down 80%. I don't know what the future is going to bring, but we just need to be aware that during bear markets, there are massive rallies, and we are not market timers. So what we're trying to do is we're trying to avoid long-term downtrends, and we're trying to capture long-term uptrends. We'll talk a little bit about this later. I've used the Michael Johnson versus the Jamaican relay team analogy a few times now. I think it makes a lot of sense. So we just need to be aware that the way that the evidence right now, as painful it is to be sitting out watching the market go up day in, day out, that the weight of the evidence does not signify that there's an all clear moment and we need to get back in. What confirms this for us is our asset class rankings. And this is looking at it on a bi-weekly basis. And you can kind of see items 4, 5, and 6 are typically the risk on assets, domestic equities, commodities, international equities, and the risk on assets are still cash, fixed income, and currencies. And cash and fixed income are so statistically close that they can basically be tied for first. And so we go where the relative strength is on the intermediate term basis. And as a result, that's why our portfolios have fixed income. That's why our portfolios have cash, because those are the areas right now that are either safety plays or they are making money. Our fixed income portfolios have done perfectly fine over the last several weeks. Despite the market rallying, they don't need to be correlated to move up and down together. One question I have gotten, or we've gotten as a firm, is like, why hasn't the U.S. moved up more in our rankings? And the fact of the matter is because, and I showed that slide before, is that small caps and mid caps are still decimated. They've been huge laggards relative to the large cap. Large cap, it's really been what's held up the market at all has been those those FANG names, some healthcare names, the consumer staple names, and no bull markets begin with consumer staples rallying. It's just not the way it historically has worked. Could change. This might be a new normal, but as of right now, that's not what history has told us. And this type of relative strength asset class ranking has done a very good job over the long term of identifying themes despite short-term movements. And I do think, as investors, because domestic equities has been really over the last decade the #1 ranked asset class 90% of the time. Now this slide's a little bit old, but it's actually, I think, worked out to be 90 or 91% from 2010 to 2020. That we're very domestic equity focused. But you can kind of see, like in the 2000s, for example, international equities and commodities were ranked #1 close to 84% of the time. So there could be a market environment where, in order for us to generate returns on your portfolios, where U.S. equities might not be the dominant player in your portfolios. It might be international equities, it might be commodities, it might be fixed income, it might be some other asset class that drives returns over the next decade. That's why we use this relative strength tool to kind of help us guide us with our asset allocations. Because we don't know what the future is going to bring. We cannot predict it, but we can look at the data in front of us and make the decisions based on the data that we have. So our overall thoughts, until we see those risk-on assets move up the relative strength scale, we continue to see the rally right now as a bear rally in a bear market. And we talked a little bit about the different time frames, and all of them had face-ripping rallies up to a certain point before the downtrend continued on. So we don't think we're out of the woods yet, but we're being consistent. We're not being emotional. We're looking at it day in, day out, looking at the data, making those decisions based upon the data. Again, I talked about, and of course I spelled Jamaican wrong, so I apologize. Michael Johnson being the fastest 400-meter runner in the world, but he's actually 3 seconds or 2.5 seconds slower than the Jamaican relay team. And even though the Jamaican relay team has to slow down to hand off the baton to go to the next person, who then speeds up to hand off the baton to the next person. That's basically what trend following is. We're looking to find trends, and tops and bottoms we're not going to do quite as well, but during the meat of the trend, we speed up. And then the last part is that for those of you who truly have the fear of missing out and want to have some additional exposure, we do run individual equity models that do more or less stay fully invested all the time. Now the benefit of that is, during a market rally like this, hey, you're participating. But when the market's going down, guess what? You're also participating. So it is a double-edged sword, but it does keep you more invested through these full market cycles. Thank you again. We appreciate everyone out there. I hope everyone's staying safe. If you have any questions, please reach out to your financial advisor. We'll be talking soon. Thanks.